What's going on, everybody? Liam O'Reilly, Vermont Economic Realtor with Jerry Riley Real Estate. I hope you're doing well. We are going to talk today about mortgage rates again and what's going on in the bond market, how the bond market is affecting mortgage rates, and where we could see rates go, a scenario where mortgage rates could go higher than what I was expecting. A few days ago, I made a video about mortgage rates, and I theorized that mortgage rates won't hit 10% by April because it seems to me that the Federal Reserve has basically hit their terminal rate or is nearing their terminal rate, and rate cuts are going to start next year. But despite that information being out there, being public knowledge, and a lot of other people speculating that there's rate cuts coming next year, even the Federal Reserve saying that rate cuts will likely take place next year. Bond prices, specifically the 10-year Treasury, the yield has completely shot up, and bond prices have dropped. And so I wanted to talk a little bit about what's going on in the bond market and how, despite the Federal Reserve cutting rates next year, why we might see mortgage rates go higher, or really just the situation that we're in the mortgage market and in the bond market. So let's get right into it. First, I wanted to shout out one of the commenters who frequents my channel and watches these videos. Jefferson, thank you so much for being a part of this community. Jefferson commented that he believes that rates could go higher, and he speculated it's because the excess amount of government debt that we have, and I'm not sure the exact reason for it, but ever since Jefferson made that comment on my video, I've seen more and more articles come out about how the demand for bonds and the demand for treasuries has started to decrease. And that's what we're seeing in this article right here. Global bond rut deepens before receding on relief rally. So, what are they talking about in this article? They're talking about how the 10-year Treasury has just spiked up to 4.88%. And it says it right here. The sell-off has been really dramatic. It's been rapid. It's been huge. The market was so oversold that it was looking for a catalyst to rally on, and found that in ADP. So the catalyst to rally on that is what the yield bounced off of. So the 10-year Treasury yield bounced off of that. And what is the ADP that he's referring to? It says right here, Rupert referred to ADP National Employment Report that showed U.S. private payrolls rose by 89,000 in September, the smallest gain since January of 2021. So a sign that the economy is slowing, and essentially they're using that to he's theorizing that the market is using that to say that rate cuts are coming in the future. But why would a mild rate cut? Why might mild rate cuts not affect the mortgage market? Let's move on to this next article by the Wall Street Journal, and talk about what they're talking about here with this title. Why 8% mortgage rates aren't crazy. So let's get down into to see what they're saying. So she starts off by saying something that we talk about a lot on this channel. For years, the Federal Reserve or big banks, often both, were significant and somewhat indiscriminate buyers, they're talking about, of treasuries and mortgage-backed securities. Now that isn't the case. Of course, the Federal Reserve is trying to shrink its balance sheet at a rate that we have never seen before. Of course, they increase their balance sheet at a rate that we haven't seen before, but they're also starting to shrink their balance sheet. And so here we have the relationship between, this is the 10-year Treasury graph. You can see it's just over 4%, or I wanted to see fixed rate bonds, current coupon, real and 30. Yeah, 10-year yield notes. So the 10-year Treasury is at the bottom here. That is the base rate that these mortgage rates trade off of. Then above that, we have the mortgage bond. So that's what your mortgage is sold for on the open market. And then above the mortgage bond, you have mortgage-backed, or you have the mortgage that you actually get, and that's where your rate is set at. So she dissects it really nice here. So current coupon yield on mortgage-backed security is 6.4% at the end of September. This was a few days ago. Rates are a little bit higher now. That's a 1.8% premium from the 10-year Treasury versus a 21st century average of around 1 point. So basically, we're 0.8 percentage points higher on our premium from treasuries to mortgage-backed securities than we have been historically. So there's a higher premium for that mortgage-backed security over the US Treasury. Then it says here, on top of that, profit earned from mortgage originators who make loans sell them to the market. The end result is that the typical 30-year fixed rate 30-year fixed rate on new conforming mortgages are more than 7.4% at the end of September, and it's even higher than that now. The best you can get right now at NEFQ is 7.625%, which means the average is probably around 7.8, 7.9 for the average, maybe at NEFQ, and then other lenders are going to be more expensive depending on who you use. So essentially, what's going on is there's the 10-year Treasury, which is which is the yield is increasing, and that's making yields across the board increase. And then on top of that, there's a premium. Investors want a premium for mortgage-backed securities because it's seen as a riskier investment. Right now, that premium is higher than it has been in the past, at least in the the average that it has been over the 21st century. And then on top of that, there's mortgage originators, loan officers, lenders who charge a premium on top of that in order to originate the loan and sell it on the secondary market into that mortgage-backed security. So that is where the full premium comes into effect. And they say here, the author says that we're at 2.8% roughly. It's at 7.4 versus a 4.6% 10-year Treasury. The pandemic average, or the pre-pandemic average, excuse me, from 2017 to 2019 was under 2 points. Now, why is 2017 to 2019, why is that a good average to compare as opposed to, say, 2015 to 2017? Now, I think that 2017 to 2019 is a good data point to reference, because if we take a look at the Fed's balance sheet, which is what we're looking at now, from about 2018, right at the beginning of 2017, or right at the end of 2017, beginning of 2018, to the middle of 2019, looks like Q4 2019, the Federal Reserve was reducing the size of its balance sheet. And we can see that clearly in this chart. Now, we had post-Great Financial Crisis where the Federal Reserve increased the size of their balance sheet and tried to stimulate the economy, and that's what we see here as their balance sheet starts to grow. We have significant growth from 2012 to 2014, but also from 2008 into 2009 here, and then significant decreases from 2017 through 2019. So this portion in the middle, they're trying to stay neutral. So they're still buying mortgage-backed securities. They're still buying U.S. Treasuries. They're trying to keep the securities that were maturing, right? If you buy a 6-month Treasury, for example, at the end of the 6 months, you're not going to have that Treasury anymore. It's going to be paid back. You have your interest. So if you want to keep your balance sheet stable, if the Federal Reserve wants to keep their balance sheet stable, they have to roll that into new debt. Once that matures, they have to buy more Treasuries, more mortgage-backed securities, whatever the asset is. So and that's what they were doing basically from 2014 to 2016. Then at the end of 2017, they started reducing the size of their balance sheet like they're doing today. So that's why I think that 2-point premium is a good reference point to go off of. So let me just bounce back to this article, see if there's anything else we want to touch on. She speculates that the reason why this premium is so high is because investors aren't certain that the Federal Reserve has peaked out. But I would argue that investors should be certain that the Federal Reserve is near its peak. All the projections say that, and the Federal Reserve even says that. Now, they say that they're going to keep it there for longer than what the market's predicting, and the market is starting to come around to the Federal Reserve keeping their Fed funds rate high. But I don't think there's much risk of the Federal Reserve spiking their Fed funds rate up to like 7%. At least if there is, I don't see that right now. If you think so, leave a comment and let me know what you think. The last article we're going to talk about, this other Wall Street Journal article, talks about bonds and the soft landing. So we see here, this is the chart of the 10-year Treasury since 2020. We have the pandemic here, marked by that recession line. And then we have the yield just absolutely skyrocketing to where we are today. You can see this big spike right at the end. So let me scroll down the article to get to the points that I wanted to highlight. reduced demand from treasuries. So the big thing that this article points out is that there's a lot of uncertainty in the market, right? Stocks are falling. There's risk of a recession all over, and so they would expect that that there would be more buyers for treasuries, more people jumping into these safer assets instead of a riskier asset like stocks. But that's not what we're seeing. Um, so here we go. Demand from treasuries from foreigners, U.S. banks, and domestic portfolio managers who have traditionally purchased government bonds as a hedge against a downturn in stocks and other risky assets. It's perplexing, Dilip Singh said, former executive of the New York Fed, who is now chief whatever economist. No fundamental explanation is convincing for why there's a large sell-off right now. Now, it's really interesting to think that during these uncertain times, people are flooding out of this relatively safe and liquid asset that is the U.S. Treasury, and they're moving into other things, or they're at least getting out of the U.S. Treasury. So investors are puzzling over why consumption has been strong despite the Fed's rate increases. Now they're talking about the overall economy, why the consumer has been strong. If it's because the neutral rate is higher, so the neutral rate they're talking about the rate that the federal Fed needs to keep their Fed funds rate in order to neither restrict nor boost the economy. So that's what they mean by the neutral rate. And what they're speculating here is that the neutral rate might have risen from a low neutral rate to around 0% or maybe 1 or 2% like it was before the pandemic to now a stronger neutral rate or a higher neutral rate because or where we're at now, because the economy is so strong, because the consumer is so strong, despite the Federal Reserve hiking up their rates. Personally, I don't think that's the case. Personally, I think it's just a lag effect, and we haven't seen things fully come into place. But here's the big thing that I wanted to point out, and what I think is going on in the bond market. Right here, what Singh says. What we're seeing is a reappraisal in how the bond market prices uncertainty itself. The compensation required to underwrite potentially the new structural regime with more volatile growth in inflation and fewer predictable sources of demand to absorb the record amounts of government debt issuance has clearly risen. All right, so there's a lot to unpack here, but basically I think what they're saying is that we're in a new world now. The Federal Reserve is not buying these U.S. Treasuries. They're not buying mortgage-backed securities. The U.S. government is printing a lot more debt, and they continue to print debt. So there's constant securities and constant treasuries flooding the market, and the risk of there being more treasuries to buy, more treasuries available than there are buyers out there, is what's causing rates to increase. And I think that is the case. Is we've entered into this free market system where the demand for U.S. Treasuries, or the supply of U.S. Treasuries, is starting to exceed the demand, which is why rates are skyrocketing. And it might be, it might be that there's too much debt now, like Jefferson pointed out in his comment, but it also might be that we're issuing debt at such a record level that it's not necessarily the amount of debt that we hold that's the risk, but it's the amount of new debt that we continue to bring to the table. It's more debt than the market can handle. It's more debt than there are buyers available to purchase that debt, to lend us the money to get the return. And I think in turn, that uncertainty, where we're at in the market, the uncertainty of the sell-off that's going on in the bond market, of the repricing going on in the bond market, without the Federal Reserve stepping in to stimulate these U.S. Treasuries and these mortgage-backed securities, there's a ton of uncertainty, which is driving U.S. Treasuries up and is driving mortgage-backed securities and mortgages up. Now, I think the greater this uncertainty, until people figure out exactly how to price it, until the market figures out how to price these rates, there's a chance that we could see the spread increase. So without the Federal Reserve increasing their Fed funds rate, without the U.S. Treasury hiking up too much, we still could see mortgage rates increase as there's more uncertainty in the market. So anyway, long video today. I hope you guys got something out of it. If you're looking to buy or sell a home anywhere across the country, reach out to me directly. I'd be happy to help you. Let me know what you think. This is a interesting topic about mortgage rates and about the bond market. I love to know what you folks think. I learn a lot. Jefferson, thank you for your comment. Other than that, See you guys in the next video.